All with markets at an all-time high, and if one looks at the recent bout of outperformance, go to rub your eyes. It is mesmerizing to see how India has gone really against the grain. India is world's fifth largest economy. Can we be isolated like a tiny oasis? Well, we cannot because we are the fifth largest economy in the world and one amongst the top 10 market. So is the outperformance here is the outperformance real, and to understand that where is value and where are bargains in this market gives me great pleasure to bring on board my very dear old friend Nilesh Shah of Envision. Nilesh, fantastic to have you back. Thank you for joining us.
Thank you,
First
Nilesh.
time we are meeting after COVID, so feels really nice.
Absolutely, and always a pleasure to be with you.
On Wall Street, the bears are saying we are the boss. In India, the bulls are saying we are the boss. Who's the boss? Boss kaun hai?
I guess both are bosses. I guess for the US, obviously they're kind of staring at a recession. High inflation, high interest rates, demand destruction, slowdown, recession. I clearly think that's a reality for the United States. For India, it's very different. We seem to be kind of cruising along at the 6 to 7% GDP growth rate, with inflation rates which are even lower than what the United States and Eurozone are experiencing. I don't think in the last 30 years of my career we have ever been at this situation where we are having higher growth and lower inflation versus the developed economies. And that, I think, is truly like a Goldilocks moment for India. And it looks a lot more sustainable than what we have seen in the past cycles. So to that extent, I would tend to agree that US has its own set of challenges. India is having its own set of opportunities.
We are using the word decoupling once again. And a polite reminder here is that 2007, when we used the word decoupling, it came back and haunted us. My whole submission here is that while India on a standalone basis is a great case, but we are the fifth largest economy in the world, one amongst the top 10 market in the world, a high recipient of FDI, and we are leaning a lot on PLI schemes and exports. If world is slowing down, we cannot be isolated.
Surely, we won't be isolated. There will be some bit of collateral damage. Decoupling, I think, is being too optimistic, or it's like stretching it too much. But probably we'll have less coupling, I would probably say it, put it this way. What has changed between past cycles and now is the whole China plus strategy. And I'm talking in context of global demand, its impact on India and India's exports. The kind of policy changes that we've had in the last 5 years, I think provide a strong tailwind to Indian exports. PLIs, GST, the whole availability of power, lower interest rates, all these essentially are strong tailwinds for India's exports. And on top of that, geopolitically things have changed quite dramatically. Everybody is looking for that China plus destination. India clearly seems to be on top out there in terms of the choice for the China plus destination. And that, to me, I think is a huge positive going for India. So while the world will slow down, but India will continue to get its fair share of exports purely because globally, Fortune 500 companies are looking out for other destinations to outsource from. And that, I think, is again a huge positive for India.
Let's start with the sector which you track very closely, IT. At the beginning of the year, it was all about IT, nothing could go wrong. Now the consensus is nothing could go right. Is there a middle place where IT will settle?
It looks like, I clearly believe that the froth is out. Margins are going to kind of settle at slightly lower levels. But demand should not be such a big challenge. Demand should sustain. It's not that even in calendar year 21 that our technology companies were kind of growing at like 15-20%. That was not the case. We were probably growing at about 10 to 15%. I think that kind of a number is sustainable because the demand for India's IT services is very non-discretionary. It's all about application development and maintenance of technology platforms, digitization, all of that. That's a reality. And I don't see demand being affected. What I definitely see are margins coming off quite significantly from the highs that we have seen in 21. And that should be fine. And valuations also have come off quite significantly. Stock prices have corrected quite significantly. So I probably think that I don't think we're going to see a correction of more than maybe 10 to 12% yet in IT stocks from here.
The index is on 25% this year.
Yeah, so maybe you probably will have another 10% of kind of a correction yet. I think at that point of time, IT again becomes very attractive from a medium to long-term perspective.
The sector is likely to grow, let's say, in early double digit, and there is a dividend yield, including a buyback, will be done of about 3.5%. So, what is the real P multiple the market should give to a business like IT services?
So if we look at our markets, on one hand we have the consumer companies growing which get a 50 plus P multiple. We have a lot of the B2B companies which get 10 to 15. I think IT should be somewhere in between. I probably think a number like around 25 times on trailing earnings. Trailing earnings. I think that creates a good opportunity for the large cap IT companies.
Okay.
Tier 2 IT companies, I think they probably will get much higher valuations because they are the growth stocks. They're not just necessarily defensive, but they're growth stocks. If the larger IT companies grow at 10, 12, 13%, I think a lot of tier 2 IT companies can grow at maybe around 15 to 20%, more like 17 to 18%. That I think is fantastic. When you have a situation where revenue growth is 17 to 18%, margins are north of 20%, ROE is 25%, and some of the companies now hitting $1 billion revenue mark, my sense is they'll probably deserve even better valuations. If at all, I think liquidity will gravitate away from large cap IT companies to some of the tier 2 IT companies. And that I think is the big opportunity.
The sweet spot for mid-cap IT is engineering design services.
Yes.
These businesses have had a deep swell in last 2 or 3 years. But assuming that there could be a recessionary trend in Europe and in US, obviously it will start impacting the capex, it will start impacting the demand for engineering and design services. Is that a valid argument that these businesses will start slowing down? Because while the need for large cap IT basic business, which is servicing banks, pharma, retail verticals, will be on, but specialized companies will bear the brunt of recession?
Partly true, but I still believe that the two big things going for India are number one, the competencies, and second is essentially the cost. There is still a cost arbitrage. The salaries of people in the US versus salaries in India, there's still a huge difference. And when you face a slowdown, when you are facing a recessionary environment, it's very normal and natural for businesses to still further see how costs can be rationalized. And I think in that environment, the case for offshoring gets even stronger versus an environment which was there in the last 3-4 years. So I actually believe that maybe there could be a bit of a pause for a quarter or two, but post that, you would actually see offshoring gaining even bigger momentum. And keep in mind that the dollar is strengthening, the rupee is depreciating. That makes our cost proposition even more attractive than what it was in the past. So I clearly believe that obviously the starting point is competencies, and our technology services companies have great competencies. They add value to their clients. On top of that, there is a cost arbitrage, which is even getting more compelling. And that I think is going to swing hugely in favor of some of the tier 2 companies which offer very specialized offerings.
You're still holding on to LTTIS?
Oh, absolutely. I mean, it's amongst our top holdings. We like it. We like what they do. They are probably, I think, this financial year, they're going to be hitting a run rate of $1 billion in revenues. And the other big opportunity which I see is the fact that their EBITDA margins are yet around 20%, which is way lower than the EBITDA margins of some of the larger IT companies. The larger IT companies have EBITDA margins of more like
25, 26,
24,
yes.
25%.
But that's TCS. I mean, Infosys would be 23, 24. Wipro is sub 10, sub 20.
Yeah, but Wipro, I think I would probably put Wipro and HCL Tech a bit separately. But if I have to kind of just look at Infosys and TCS, their EBITDA margins would range at 23 to 25%. And then if you really look at it, some of the specialized companies like Tata Elxsi, their margins are north of 30%. Now for me, that itself, this whole journey from 20%, leave aside the 30%, but that journey from 20 to 23%, maybe even over a period of 3 to 5 years, and a solid revenue growth, which is in mid to high teens, I think is a great combination to have with the kind of pedigree and the capabilities that L&T Technology Services have. So we've been owning it now for a long period of time, continue to own it, and I continue to be extremely positive about it.
What will challenge your belief in LTTIs? What would be that data point which will tell you, okay, I'm not okay now with what they're doing?
I would still think that the business opportunity is there. I think the ability to gravitate towards higher margins, I think is going to be the big opportunity. But if that does not happen, then I would tend to doubt the way they're probably running the business, or the way they basically see the opportunity. Okay, because I think the kind of work that they do, they surely can drive better margins. Obviously, right now, scale is a challenge. They're still not yet a $1 billion revenue company, but I think once you get into a $1 billion, $2 billion revenue game, and then it should manifest into better margins. And I would want to see LTTS move from that 20% EBITDA margin to 25% margin. I'm fine if it takes another 3 to 5 years. But to me, that is the big thing. I think the day that happens, I think there will be a very strong case for a further re-rating of LTTS. But if that were to not happen, I think that would concern me.
In a market, there's always a time to reap and there's a time to sow. Where are you reaping gains and where are you sowing for the next cycle?
So, well, we are reaping gains in some of the auto component companies that we bought earlier and which probably are more exposed to a market like the US, and with the kind of slowdown and recession expected, they could face some challenges. So that's one pocket where we are taking some money off the table.
Why not complete money?
No, we're beginning to take that
You're exiting your positions in auto ancillaries.
Absolutely, we're trimming, we're exiting, not overall auto components, but I think the ones which are more US facing versus the ones which are more domestic facing, I think we still like them and we continue to own them, and I don't think we're seeing trimming that kind of pocket. So that's one. Two is some of the capex plays which we had bought maybe even 6 or 12 months back, which have had a phenomenal run. I think there we are taking some money off the table.
Why?
We are trimming. I think we are seeing relatively better opportunities. We're seeing areas like, say, defense, where we see an incredible opportunity for the coming decade. We see defense to be kind of probably a sector which IT was maybe 20 years back, a huge opportunity. And with this whole buzz and this tailwinds of manufacturing and the government's thrust on indigenization, clearly believe defense is a huge opportunity for the next 8 to 10 years. And we see, and valuations are way more attractive on the defense pack versus the capex packs. Valuations in the capex side have run up quite significantly. So that is making us trim or take some money off the table and allocate that money to defense.
A follow-up question on defense is that while we can compare, let's say, capex-dominated names with defense-dominated themes, the capex or pure play capex are engineering companies.
Yes.
They have patent around them. Their ROS and the return ratios are phenomenally higher than what PSU defense companies have. PSU defense companies essentially will not have margins which are more than 15-18%. Will that be an interesting business, considering that while the growth is there, but the ratios in terms of margin, operating leverage is not there?
So, in the medium term, the market is about capital efficient growth. And I think while the capex companies will also probably grow earnings at about 20% odd, I think the defense companies can have earnings growth which are more like 25 to 30% annualized. And when you have that kind of growth, when you have better operating leverage, the margins will also improve. And as margins improve, the ROE and the ROCs will also improve. We have to keep in mind that our defense companies for the last 3 to 5 years have not had great revenues. Orders are only trickling in now. The order book is now only increasing. The order pipeline is increasing. Now, orders, order book, order pipeline will convert into revenues in the next 3 to 5 years. And that revenue growth is going to be a lot higher than what we have seen in the last 3 to 5 years.
What do you own in defense?
We own 2 PSU companies, defense PSUs. One is Bharat Dynamics, and we own GRSC, which is Garden Reach Shipyard. These are the 2 names that we own, and we are also basically looking at some of the private names as well.
Are these recent purchases?
These are more recent purchases, I mean over the last few months.
Why not a HAL or the obvious one, which is BEL? Why did you skip them?
I think BEL is great, it's outstanding. It's just that probably BEL's growth would be more like 15 to 20%. Whereas the kind of order book on which, say, a Bharat Dynamics is sitting on, or the kind of order book on which a GRSC is sitting on, their growth rates will be more like 25 to 30% versus the 15 to 20% which might happen with Bharat Electronics. So I think that essentially is a key difference. 2 is a company like Bharat Dynamics, what it does is essentially missiles.
Okay.
And that's the only company which does missiles. What Bharat Electronics does, I think you're going to see increasing amount of outsourcing to the private players. Whereas for missiles, you are not going to see outsourcing happen in a big way for the entire missile system. There
I
will,
think
of course,
Akash is still with BL, if my memory serves me right.
so it's, of course, a lot of things they all work together on, but basically for Bharat Dynamics, the core competency is around missiles. And that's something you could probably talk of this being an embedded right to win, which they have, which nobody's probably going to take it away from them. And then, of course, on top of that, the order book which is there and the order book which is expected, or the order pipeline which is there, I think is humongous. Okay, so that's why I think Bharat Dynamics looks even more interesting. I'm not saying Bharat Electronics is not interesting, but maybe if the valuations come off, if there's a correction, maybe Bharat Electronics might become attractive at that point of time.
We've spoken about IT, we've spoken about defense, but your top two holdings essentially are liquor companies.
Yes.
So you're still liking that snack plate? Have liquor in it, have snacks in it?
Oh, absolutely. I mean, we love that space, very positive about it. We've been liking it for a while, but still believe the runway is huge.
Why both? I mean, you could ideally portfolio
Sure.
managers there buy one.
Yeah, so when you like the space, you want to buy as many as you can. And there are two very prominent companies, both Radico Khaitan and United Spirits. United Spirits, of course, is on a kind of a bit of a turnaround. They've had a period of 5 to 8 years of underperformance, limited growth. There's a change in the leadership, there's a change in the strategy, there's more focus towards premiumization. And that to me is an opportunity from a 3 to 5 year perspective. The next 2-3 quarters could be challenging for all liquor companies, including United Spirits, because of margin pressures. But I think post that, they should be able to pass on some of those margin pressures. They get price hikes, and then there can be better traction, better volume. So I clearly believe that United Spirits probably is on a turnaround path. So that's, I think, why United Spirits is exciting. Radico Khaitan is essentially a challenger. He's the one who's challenging the champions. Which is the champions in the form of Diageo, Pernod Ricard, and all of that. And there's, of course, a very strong premiumization strategy. I think in addition to that, what I have liked about Radico Khaitan, I think, is their frankness. They were the first to call out saying that there are going to be margin pressures. Okay?
They've turned around their debt.
Paid off debt, and they're trying to de-risk their entire chain of raw materials, where they're moving away from only the sugar-based ethanol to essentially moving also to grain-based ethanol. That I think is a very, very interesting proposition, a very interesting strategy. I think they have demonstrated conviction, they have demonstrated courage, they have demonstrated perseverance. And I think therefore that they are in for multi-year growth. And that's what I think makes Radico Khaitan also interesting, and that's why we own both the companies.
Let me divide the market into time period. That's the best way to divide the market. Then you can essentially frame your thoughts there. What looks interesting from 12 to 18 month time frame? What looks interesting for 3 years, and what looks strong and steady for 3 years beyond?
So we hardly look at the 12 to 18 month kind of a period, because it's always hard to take a call on businesses, especially in a volatile
For example,
environment.
you got capex plays, so
Yes.
that must be a 2-3 year play, right?
Yeah, so broadly, yes. I mean, I think the capex plays are more around the 3 year kind of plays. From a 15 to 18 months, some of the domestic facing auto component companies still look interesting. I think the automobile sector is in for good times for the next 12 to 18 months, and therefore the auto component companies look good for the next 12 to 18 months. I think from a 3 year perspective, the capex plays look good. Tier 2 private sector banks also look good from a 1 to 3 year perspective. I think the worst is behind them. They've essentially done a lot of hard work. They've done a lot of cleanup. I think they are heading for better times over the next 1 to 3 years. So we like the tier 2 private sector banks. From a more longer term perspective, I think I would still think that technology stands out, technology services stands out, and defense really stands out. For now,
5 year, you're okay to own defense stocks.
we're okay to own defense stock, unless in between, of course, the market gets too exuberant and the valuations kind of gravitate significantly higher, which prompts us to take some money off the table. But otherwise, purely as a business, as an opportunity, to me, defense today is a 5 to 10 year opportunity.
When we will look back and analyze the period of June to September, this is one of the biggest outperforming. India has been one of the biggest outperforming market. And rarely we've seen this kind of a massive outperformance. It's not the absolute gain, it's the level of outperformance. So year from now, for those who believed in this market, they will be rewarded, or those who use the strength to sell and gain some, raise some cash, they will feel happy.
I'm not too sure whether selling and just for the sake of raising cash is a good idea. You sell when you believe that things are overpriced or overvalued. That's what should prompt you to basically sell, but not just to basically raise cash and sit in cash. Or you see some relatively better opportunities because of which you want to sell and buy into those kind of opportunities. So I honestly don't know how markets may behave over the next 2-3 months. I honestly don't know. But I think over a 1 year, 2 year, 3 year, 5 year horizon, I think India still is looking extremely compelling. And I think this kind of outperformance that we have seen in the last 3 months, I think should sustain for a period of 3 years and beyond. So I think the call right now should be in India's sustained outperformance. And I believe there's a very strong case for India to sustain its outperformance.
So spend time in the market rather than timing the market.
Absolutely. I mean, it's going to be hard to time this market. And then there are so many kind of opportunities which are emerging that at this point of time, it doesn't make sense for you to just be sitting on cash because you believe the markets will correct. Markets may correct, but that's fine. I think volatility is going to be part and parcel of this game. But I think you have to be fixated on a multi-year horizon rather than on a horizon of a few weeks or a few months.
Nilesh, I've been wanting to have this conversation because what I've admired about you over the years is that you pick up a mega trend and then you try and fill in colors here. And just for the benefit of our viewers here, for example, Sibyl was a mega trend, and that in a sense led to the birth of great lending franchises like Bajaj Finance, because risk management in a sense was something which was digitally captured. That gave birth to some of the most fantastic lending franchises last 1 year. DMart, a great franchise which got created in last decade. So what is that trend which is going to have a very large impact in terms of rate of change, and then businesses will board on that?
So the big change that I see, I mean, and you talked about some of the firms being able to build a lending franchise, exactly, or even a banking franchise, and we saw how periods
that's Aadhaar, UPI, all of them
2010 to 2020. Yeah. I think 2020 to 2030 is all going to be about firms which can build a savings and investment franchise. Okay. I think that we as Indians are going to essentially have a much higher, our per capita are going to grow, our savings rate is going to get better, we're going to move away from physical assets into financial assets, and I think the whole trend of savings and putting money into financial assets is going to gather major momentum. And therefore firms which are into online broking, online mutual fund distribution, into wealth management, I see these kind of firms over the next decade become significantly larger than where they are today. So I clearly believe this is pretty much like where the United States was in 1950s, 1960s, including AMCs and all of that. So I think that entire pack, I think, is going to become extremely interesting. And
what's the goal post for Envision Capital? Because you're in the same business.
Oh, absolutely. So I think
is there a number you're chasing?
We're not chasing a number right now, but yes, we have, of course, our own growth plans, and I think we too aspire to be significantly larger than where we are today. And thankfully, I think clearly the canvas is set, the platform is set, and the opportunity is going to be humongous.
Will you ever go public, or you'll always remain private?
Why not? Why not? I mean, I think if we see that there's a case for going public somewhere down the line, why not?
Nilesh, how did you deal with the COVID pain? Everything was just jammed, right? History taught us that when you don't sell into a crisis, you are rewarded. But it is important to refer to history, but it is very hard to keep sanity going. When you see 50% fall in a month, when you see a 60% decline in your falls, how did you deal with it?
Well, that was truly a terrible period. I mean, that was a challenging period. But clearly the experience of the past really helped. So that was honestly not the first down cycle that we saw. I have experienced the dot-com bust of 2000, 2001. I have seen the GFC crisis, the Lehman crisis of 2007, 2008, a bit of what we saw in 2013, and then of course 2020. So clearly, of course, that was a crisis period, and every adversity, you keep saying, oh, this time it's different. Yes, yes. It's not like the past. Here you're dealing with human lives and all of that.
Even Buffett was...
So, absolutely. So it was truly terrible. It was truly challenging. But thankfully, we managed to navigate through all of that by remaining calm, remaining composed. And what we said is that this adversity is going to throw up a new set of opportunities. And our focus was essentially on what are the kind of new opportunities that we think both from a business point of view as well as from an investment point of view. And that's what we focused on. So after the initial period of a bit of caution and all of that, we reoriented ourselves, our thought process, saying this will pass. And therefore, let's look at the brighter side, the positive side. And we chose to do that. And I think that helped us in good stead.
Let's get disclosures going. We've been very stock specific. I always encourage a stock specific conversation when you are there, but let's get the disclosures going.
Yeah, so safe to assume that I and the firm have a vested interest in all the stock names that we have taken and discussed in this session.
Either you invested in them or you're planning to buy them.
Absolutely. And therefore have a vested interest in all the names that I have taken.
Appreciate that. That's it on this edition of Market Makers. I've been waiting for this interaction with Nilesh Shah in our studio. Glad it happened. It took 2.5 years. We'll blame it on COVID. But